Hello, and thank you for joining us for the Investors Trust Company 2020 Mid-Year Economic and Investment Market Update. My name is Adam Morgan. I'm a member of the investment team here at Investors Trust, and I'm joined by Bob Fontana, the Chief Investment Officer of Investors Trust Company. This format is new for us as we break from tradition a bit. As is typical, we produce a written commentary, which each of you should have already received. If you hadn't and you would like to, please let us know. But we thought we'd produce a video in this particular format as a way of evolving to meet the times and as a way of staying front and center and available at a time when we simply cannot meet as often as we would otherwise like. So we have a few slides for you today, which we believe encapsulates what has occurred so far in 2020, as well as where we are in the U.S. economy's recovery and stock market rebound. We'd also like to talk about how we view the market from a valuation standpoint, and also discuss what we're thinking about as we go into earnings season, which is already underway. Let's jump right into the first slide, which is a slide of the S&P 500 index. The S&P 500 is a broad index of U.S. large cap companies, and this is the year that we've all endured. As you can see, the market was off to somewhat of a good start at the beginning of the year, as the nation was embroiled in a televised impeachment trial of the U.S. president. The market was digesting that quite nicely, actually. And then around February 20th, the news of the viral spread had sent the markets into a panic. And what followed was the single most volatile month in the history of the U.S. stock market, as measured by a volatility index. We had counseled clients then to focus on long-term goals and objectives and to stay invested. And that was tough advice to offer and more challenging to receive, I'm sure. But what followed was the best 50-day period in the history of the U.S. stock market, where we rallied almost 40% off the bottom. And so once the market had realized that A, this virus is transitory, and B, the federal government was willing to support the markets to any end necessary with both fiscal and monetary stimulus. And in fact, all central governments, all central banks around the world were really acting in a coordinated fashion to support markets. The market was able to see past the valley to the peak. Bob, the question today is, where does that leave us now?
Yeah, well, I mean, as you rightly point out, Adam, I mean, you know, the bottom of the market was in late March, as you see on the chart there, but, you know, it surged, you know, for kind of three primary reasons. There is some investor enthusiasm about the reopening up of the economy. I will say, I don't think the market thought it was going to be smooth. I don't think it has been smooth. We are certainly seeing a surge in COVID-19 cases across a number of states. In fact, many states that we are currently residing in, I'm sure many of you as well. So I don't think the market necessarily expected it to be smooth, but I also don't think investors believe that the government's going to shut the economy down the way it did back in March. So for that, I think the market has celebrated that. Again, doesn't mean it's smooth, and certainly the recent surge in COVID-19 cases has made us pause. But that's one of the reasons. And you alluded to COVID-19 being a temporary factor. That is true. The market has been focused on the science around vaccines and therapeutics and whatnot. We don't have a vaccine yet, but there's a lot of positive progress on that front. In fact, there are over 180 vaccine candidates right now in various stages of clinical trials. The most important thing that I think the market is focused on is there are 14 right now that are in human trials or about to be in human trials. So dare I say, it's not unrealistic to think that there could be a vaccine that is available sometime in the fall. Now I have to hedge that notably in that just because there's a vaccine doesn't mean we can all go get our COVID-19 shot. The vaccine will have to be manufactured to scale, hundreds of millions, if not billions of doses. That's not going to be available in the fall. That'll be available sometime in 2021, hopefully in the first quarter. But again, the street is trying to anticipate those sorts of things. And so that has helped shape the rally off the lows that occurred in the second quarter. And then as you pointed out, Adam, the government stimulus, the Federal Reserve, and not just the Federal Reserve, the central banks, that the Federal Reserve is bending over backwards to provide liquidity into the market. And that has reassured investors that the Fed's going to do anything it can, any and all things that it can to help support the economy during this transitory period. And that's a good thing. There's a saying that I think we're all familiar with. It says, "Don't fight the Fed." And what that means is when the Fed is doing things to help stimulate the economy, that tends to be good for the markets. And so, indeed, that has been the case thus far. Now, where we're at, very different from where we were the last time we had our conference call, and that the market has rallied sharply. And so as we sit today, our longer-term outlook remains bullish. But on a short-term basis, I think we've become more cautious. Just there are a number of headwinds that could keep the market from advancing meaningfully from here. And so, Adam, I know you've done a lot of work on some of the economic stuff and some of the economic things that we're seeing. Why don't you share some of the work that you've been doing?
Well, sure. So there's probably no better place to view the economic trauma, if you will, than the labor market. And so this slide is initial jobless claims from January 1970 through today. And you can see each of the gray areas, gray shaded areas, are recessions in the United States that have occurred throughout that time period. Initial jobless claims is a report that comes out weekly, and it encapsulates how many people had filed for unemployment insurance that previous week. You can see that in October of '82, the high was 695,000 people during that recession applied for unemployment insurance. During the height of the Great Recession in 2008, 2009, 665,000 people applied for unemployment insurance. Now you see this blue line off to the right. That is nearly 7 million people in 1 week applied for unemployment insurance. Now that's the bad news. The good news is you see that number come dramatically down, and it's almost not visible in this graph. So we'll go to the next slide. This is a more recent view of the same data. Again, you see that spike in claims. You see the number come down, but really, here's the problem. So we now have 16 consecutive weeks of more than 1 million weekly initial jobless claims. And there's been an obvious resurgence in viral spread. This number has not come down below 1 million. And so that is really one of the key reasons that leaves us a bit more cautious going into the back half of the year.
I'll note, Adam, if I could just add, yep. The government did a really good job of supporting consumption during that time with the CARES Act. The government was sending checks to individuals and certainly provided protection for payroll so that people could keep their jobs. That's set to run out at the end of this month. And so if it does, I think seeing the data that you're pointing out here with jobless claims being elevated, I know the unemployment rate is a little over 11% right now. And so, consumption is a big part of our economy.
That makes earnings season all the more important for us to monitor. Do you want to talk about?
Yeah, in fact, in that regard, I think we have preached probably to the point where you guys may be tired of hearing us say it, that the ultimate driver of stock prices is corporate earnings and the ability of companies to grow those earnings. That may not be true on a given day, given week, given month, given quarter per se, but over time, no question that it is corporate earnings that drive results. And as I will say that the market recently, and dare I say in the midst of this rally, has not really been focused so much on corporate earnings because they just expected them to be bad. Companies are about to report their earnings for the second quarter. The expectations are for them to be quite poor. In fact, the current consensus amongst investors is that earnings will decline by approximately 45% in the quarter. If that projection holds true, that would be the worst quarter since the 08-09 crisis, so certainly not a good backdrop. While the numbers that the companies are going to be reporting, the numbers are always important, I will say that this quarter, I don't think that they're going to be as important as what the management teams say about the state of their companies. And so we do a lot of work. Every quarter we go through the earnings reports of companies. We listen to conference calls. In some cases, we know these companies and these management teams. We've been listening to these calls for years and years and years and years. We know how they communicate to the street. There has been an unprecedented number of companies who have chosen to suspend their outlook. When a management team provides their earnings reports, they often provide what is called guidance. And that is basically their financial targets that the company has based on how they see their business evolving. When companies reported first quarter results, given the state of the world and the uncertainty at that point in time, roughly a third of companies chose to suspend their outlooks. And as a result, it's made forecasting quite challenging. But it also increases the importance of what it is that managements are saying about the state of their companies. They may not provide financial guidance specifically, but how are things trending? Did things improve in May from April? Did things improve into June? And are they improving as we sit here in July? The tone that management offers and the commentary around the state of their business is going to be very, very important. And we think it's going to frame our view, not just of the earnings outlook in general, but also frame the state of the economy and what our economic outlook would be. Now, what you see on this page here, this is the current estimates. The table on the left is the current consensus estimates on Wall Street for earnings. And as we see the 2020 number, right now the street projects that earnings are going to decline by roughly 22%. Not unexpected, again, given the state of things. But I do think that investors are dismissing this year, given the unusual nature of it, and that investors are increasingly starting to focus on earnings and what they could be for 2021. Right now, the consensus on Wall Street is that corporate earnings will grow sharply. You see there on that table will grow over 29%. In fact, that's a level greater than what we saw in 2019, the earnings level is. And so right now, Wall Street is optimistic for earnings for 2021. Our view is not so optimistic, frankly, just given that the damage to the economy has been meaningful, and that it could just take a longer time to recover than Wall Street currently expects. And so we've run a lot of different scenarios for what earnings could look like in 2021. And the table on the right there lays out our projections. We actually think a more reasonable earnings level for 2021 as we sit today is earnings in the level of $144 to $150 per share for the S&P 500. Still robust growth, by the way, coming off 2020. What that would equate to, if we're right, and we acknowledge, look, circumstances are very dynamic right now. They could change. We have an election coming up. That could change the outlook. We don't know how the viral spread is going to continue. That could change the outlook. But where we sit today, we think a reasonable expectation for earnings for 2021 is in that 144 to 150 range. And if that's the case, what would that suggest the market should be? And so you see the different levels of market multiples there. Our most realistic scenario that we think is reasonable is 20 times those earnings levels, and that would suggest an S&P 500 level of around 3,000. That's actually a little bit below where we're at today, call it 5%, give or take or so. If we look from a historical perspective, if we were to look at the next slide, this shows the historical projected earnings multiples for the S&P 500. You see the NTM there means the next 12 months. And so you see that green line across the page, the average multiple for the market is roughly 16 times, a little over 16 times. Where we're sitting today is a little over 22 times. So by historical perspective, we're elevated. That's not a surprise, frankly, because the earnings, as we all know, earnings are depressed right now. So we would expect the market to be trading at a higher multiple than it does historically. That doesn't cause us any undue concern, but it also further supports that, at least on a short-term basis, this is yet another headwind that could keep the market from advancing the way that it has over the past few months.
So Bob, just to sum that up for just a second, if you look at the estimated 2021 earnings of $162.20 for S&P 500 companies, that means that at least as if estimates are correct, there would be more corporate earnings that were produced in 2021 than all of 2019 at $161. in the S&P S&P 500 companies. So we believe the estimate that doesn't seem entirely realistic, considering we'll probably enter 2021 with double-digit unemployment. And so we believe that estimate is a little bit high. And then looking at valuation, the market has priced that in. So that's where we believe, that's really where we get a little bit of a cautious view. But because of federal stimulus and the scientific innovation that hopefully is on the precipice here, we remain long-term bullish, short-term a little bit cautious.
Yeah, and that's right, Adam. I do think it's important to distinguish between a near term and a longer term. I don't think either of us have concern about the longer term outlook. We would not suggest that our clients adjust their asset allocation to equities, even though this has been a much longer and dare I say painful temporary issue. It still remains temporary. So
in summary, the stock market has recovered significantly, although high unemployment does remain. The 2021 consensus corporate earnings estimates do appear high to us. The market appears to already have priced in those elevated 2021 estimates. The recent surge in viral spread is concerning, and it will affect consumer demand, but the Federal Reserve remains extraordinarily accommodative with unprecedented amount of stimulus, both fiscal and monetary, with interest rates at zero. Again, financial asset prices are supported. That is our cautious tone going into the second half of the year, but we do remain long-term optimistic.
Yeah, so let me just thank everybody for watching and just thank you for allowing us to serve you. It is an honor for us to do that, so we do appreciate that. And given these unusual times that we live in, we certainly wish you and your families good health and safety during this time.
If you have any questions or would like any more information, please contact your wealth advisor or Bob and I directly. Investors Trust Company is here to help. Thank you very much and be well.
Yeah, thank you.